So on this week's program of Dollars and Cents, we thought it only appropriate, given the headlines of the past week, to talk a little bit about market volatility. This may be one of those shows, and doesn't happen very often, where we focus on a single topic because it is so timely and it is so important that people sort of understand all aspects of the particular topic. You know, normally on the program we talk, we usually have 2 or 3 different topics. This one, we're just devoting straight to market volatility, what went on this past week. And on this segment, we're going to talk about what we see as the root cause of sort of this uptick in volatility. No question, economic data is kind of bouncing around all over the place. The will day, won't day in terms of the Federal Reserve raising or lowering rates. And then, of course, let's not forget that fabulous presidential election. But there's more to the story. And that's what we're going to talk about in this segment, along with giving you 2 specific things that you want to look at right now when it comes to your investments. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs. Also, a top 25 financial planning podcast on the big wide world web. Check us out on your favorite podcast channel. Any trouble finding us, or for that matter, if you want to learn more about who we are, go to our website, nelsonfinancialplanning.com. There you'll get all of that information that you could possibly imagine getting, all there in one spot on our website at nelsonfinancialplanning.com. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So the root cause behind a lot of this volatility is certainly something that we've been talking about at length on this program over the course of the past couple of years, and something that we've been warning you to sort of be careful about. And that's really this notion of market concentration and how much a very small number of companies has in fact been driving the overall performance of the market. And in a way, it's sort of creating this false sense of across-the-board performance in corporate America, right? When we think about an index, or we think about the S&P 500, right? 500 companies. That's what it is. That's the definition of it. But it's market capitalization weighted, which means that the bigger you are, the more you're going to drive the performance of that particular index. So we've heard the names FANGs, we've heard the names Magnificent Seven. The reality is when you start to parse the data, it's actually kind of staggering how much that concentration is. In 1999, peak of the dot-com bubble, the 30 largest companies in that S&P 500 index accounted for 42% of the total amount of that index. Okay? 99, top 30. Remember it very well. Maybe you do too, but I was in the business then, and I remember it very, very well. It was right at the beginning of my career, and those things that happen at the beginning of your career really do stick in your mind. And so the 30 largest companies, 42%, right? Today, well, if you look at June 30th, obviously the numbers have shifted a little bit as a result of the volatility over the past few weeks. June 30, the top 30 companies accounted for 53%. So in a lot of ways, you have a market that is more concentrated, or 20% more concentrated than it was at the height of the dot-com bubble. We have some concerns on that, and so should you. I mean, the reality is that the market consists of 11 different sectors. But one of them, information technology, just that single sector, accounts for 40% of that market weighting. So think about it this way. If you were to seek out a diversified individual stock portfolio, would you put 40% of what you're investing in a single sector of the economy when there's like 10 others? Probably not. But unfortunately, when you own an index fund, that's exactly what you have. To put it further into perspective, the 3 largest stocks, Apple, Microsoft, NVIDIA, as of June 30th, represented over 20%. So three stocks, over a fifth of the performance of the S&P 500 was attributable to just those 3 stocks. Those 3 stocks basically provided performance that was equivalent to the bottom 362 companies of that S&P 500. So does that sound diversified, or does that sound concentrated to you? And by the way, we're going to let you in on a little secret, okay? And it's worse, or the concentration is worse than some of these data points that we're giving you, because what you might not realize is that the folks at Standard & Poor's, the S&P part of the S&P 500, constantly are adjusting not just the companies that are part of the index, but they're actually adjusting the particular classification that a company has to adjust for when a sector winds up being outsized in terms of its weight or its contribution to the index. We can give you two examples. In 2018, the S&P 500, or the Standard & Poor's people, decided to recategorize from the technology sector to the telecommunications services sector, both Google and Facebook. So the kinds of things that happen that you may not realize when you recategorize a company from one sector to the other, and you're doing that, as Standard & Poor's does, to make sure that you're not getting really crazy overweight on a particular sector, well, that's kind of like gaming the system, if you think about it that way. But that's what happened in 2018. And then as recently as 2023, both Visa and MasterCard shifted from technology to financials. So you can argue that they probably should have been in financials all along. But let's face it, Visa and MasterCard, certainly very technology-oriented types of companies. All of that done to sort of keep a lid somewhat on a particular sector of technology becoming an outsized weighting in the overall index. So that's what's happening. So what can you do to get to the bottom of all of this? Two things immediately spring to mind, and both relate to our fundamental advice that we give out on a regular basis on this program, which is know what you own. Know how you are investing your hard-earned dollars. Know what you own when you make an investment. And I want to break that down into two parts. So these are the two things that you want to be looking at right now in your portfolio. Number one, know what sectors you own and be careful about what companies are categorized in each. Is your portfolio 40% in information technology? Is it? Well, there's 11 sectors of the economy. So that's number one. Look at that sector allocation. Number two, look at the specific holdings. A lot of funds these days will own a lot of the same companies, because a lot of the performance in the market has been generated by a short handful of companies. So know what you own. How much do your top 10 holdings in your portfolio actually amount to in your overall, what's supposed to be a diversified portfolio? It shouldn't really be more than 15%. Okay, so you look at the top 10 holdings, and if it should be around 15%, preferably less. But for many these days, it's 30% or 40%. And so the current market volatility is going to affect your portfolio a lot more than one that is more diversified. The current volatility is going to affect you disproportionately. And certainly seeing that, if we look at the numbers, because we look at these numbers every day, in terms of the relative performance just over the course of the past 2 weeks. So in our office, that's where we share that information with our clients by running our Morningstar X-ray report. So if you're a client, you know what these look like, but basically they look behind the curtain of what you own, funds, ETFs, indexes, individual stocks, and break it out based on the sectors and also the top 10 holdings. So pretty interesting look. And that's one of the reasons why this summer we have been advertising that we will do for free an analysis of your portfolio. So if you want to take advantage of that and have us run that concentration report and risk analysis of your portfolio, visit our website, nelsonfinancialplanning.com.